Recently, a British family purchased an investment property in the US. Everything was going great until, unfortunately, the patriarch passed away. Soon after, they received a letter from the IRS asking for 40% estate tax. So, lacking the funds to pay, they decided to sell the property just to find out taxman was going to withhold an additional 15%. If this family would know what I'm about to teach you in this video, they could have avoided this tax trap with the right legal structure. So if you're interested, stick around to find out. Okay, so let's now find out what's the best way to acquire real estate in the US as a foreigner. Okay, but first, a little bit of disclosure. This is not financial or legal advice. This is just for educational purposes. So being said that, let's deep dive into this. You really have, as a foreigner, two big enemies talking about taxes. You know, the first one is the estate tax rate, because estate tax for foreigners, it's 40%. So every time if you die, if you purchase something in the US, either real estate or maybe stocks or another kind of property that it's in the US, you will pay, or your heirs will pay 40% estate tax. Okay, unless you do what I'm going to explain you. Okay, so there is one little exception for the profit on the for the estate tax, that will be $60,000. So if you inherit $60,000 or a property that is $60,000, you will not pay any taxes. But what property today, 2026, costs $60,000? I bet no property. I can find any property that it's that cheap. So U.S. national exception, it's 15 million for estate tax and 30 million if they are married. But as a foreigner, you don't have this exception. You only have 60,000. Okay. So the second big enemy you have to avoid talking about taxes in the U.S. is the FIRPTA tax. So that means Foreign Investment in Property Tax Act. Okay, so it is not a tax, but it is a withholding. So that means it kills liquidity. Maybe it doesn't kill profit, because once you file your taxes at the end of the year or the next year, you may have back those taxes. But if you don't have to pay, if you have a property and you have to pay other things, maybe you don't have the money to pay that withholding tax, you know, so maybe that you cannot sell that property. Okay, so basically it kills liquidity. Okay, so the withholding rate for FIRPTA, it's 15% on the gross income. That means if you sell a property $1 million, let's say you purchase this property in $900K, and then you sell it for $1 million, your profit will be $100K, right? So they should withhold 15% of that $100K. So that means $15,000. But I have news for you. That's not how the FIRPTA tax withholding works. They withhold from the gross income. So if you sell for 1 million, they will withhold 150. Even if your profit is only 100K. So you will not have money to pay those additional $15,000. You know what I mean with this? It's a liquidity trap. So there are basically three ways to hold real estate in the US or any property, but we are going to talk about specifically real estate. And those are, the first one is sole proprietorship or a disregarded LLC. So that basically it's you as an individual will purchase the property directly without any corporations or things like that. You may have it on an LLC, and if you have it on an LLC and you are the sole owner, that is called a disregarded LLC. Okay, so that means the IRS is not gonna tax the LLC, it's gonna tax you as an individual. So that is like, it's the same thing as the LLC never existed, you know, so it's the same thing as a direct ownership. Okay, the second is having a US corporate blocker. So that means a US corporation. So you are the owner of the corporation, and then that corporation holds the real estate, okay, holds the title of the real estate. Okay, so there's one big advantage here in the US, that you can form an LLC, and then that LLC you can have an election with the IRS, and then make that LLC pay taxes as a corporation. Okay, so that is a big thing to do, because forming an LLC is cheaper than forming a corporation. Okay, and also you can form an LLC, for example, in states like Wyoming. It's cheap, it's easy, and it has very good privacy laws. Okay, so that's one thing you can do. You can form an LLC and then make it an election to be taxed as a corporation. Okay, so the third way to hold real estate in the US, it's by a double child corporate. Okay, so this means you as an individual in your own country, you hold a corporation in that country. Okay, in that same country you are, or maybe in another country but not the US. Okay, and then you hold that corporation, you have this ownership and control over this corporation, and then that corporation holds a US corporation that could be again an LLC taxed as corporation, and then the US corporation will hold the real estate. Okay, maybe one property, maybe many properties. Okay, so what are the pros and cons of each type of ownership? First, if you own the real estate directly, it is the simplest way. You just purchase the property and that's it. Okay, it is the cheapest. You don't have to pay for any formation of corporations or LLC. You just purchase the property. Okay, so what are the cons of this form of this type of ownership? You have to file taxes in the US. Okay, so now you are having rents or something, or maybe you sell the property, you have to file taxes in the US, even as a non-resident. Non-resident can also file taxes in the US. Okay, also if you have rents from that property, they will withhold your rents, 30% of the rents. Okay, if you have a property manager, they have to withhold those 30% of those rents, unless you make an election with the IRS that it's effectively connected income. You also have no state tax block, okay, because you are directly owning the property, so you don't have the state tax block because you don't have any other corporation. You have no FIRTA block because you are living in your country, you are a foreigner, so FIRTA applies to you. Okay, so let's see the second way of holding real estate, which is the US corporate blocker. What are the pros of this? No individual tax returns. You don't have to file taxes on the US, okay, because now you have a US corporation that files taxes for you. Okay, it blocks FIRTA effectively because you have now a US corporation. Okay, and you can elect to be taxed. If you have an LLC, you can elect to be taxed as a corporation, which I told you before. Okay, What are the cons of this? This is more expensive, of course, than owning real estate directly. You have a corporate tax filing. Okay, so now you don't file taxes in the US individually, but now as a corporation you have to file taxes every year. Okay, even if you don't have any profits or income, you have to file taxes. Okay, you have no state tax block because you still have a corporation. You don't have a real estate now directly, but now you own US corporation, you own stocks, or you own membership, LLC unit memberships. Okay, so that also it's applies for state tax. Okay, so let's see the last way to hold properties, which is the two-tier corporate block here. Okay, so now you have in this structure you have two corporations, and then the US corporation holds the properties inside the title. So now you have this first, you are the owner of this first corporation, which is a corporation in your own country, or maybe in a country that has no taxes. Maybe a country that is outside of your country but has low taxes. Many people use like the Cayman Islands or Channel Islands, some jurisdictions like those. Okay, so that corporation then holds the US corporation, and the US corporation is the one that pays the taxes in the US. What are the pros of this? No individual tax return. Again, the same thing as this. This one blocks FIRPTA because now you have a US corporation that holds the real estate. So if you sell, this is a national, it's not a foreigner. So FIRPTA doesn't apply to that. Okay, so it blocks state tax now. Okay, because this foreign corporation, it's not a person, it cannot die, this one. So it's just a foreign investment. So state tax don't apply to foreign corporation, only individuals. Okay, so same thing, you have an LLC, US LLC, you can make an election with the IRS to be taxed as a corporation. Okay, what are the cons? It's the most expensive structure. Okay, so this one it's for, you know, people that has a lot of properties or a lot of assets in the US. This structure is for big guys, for maybe family offices, maybe pension funds. So this type of corporations or family offices that hold many real estate in the US. Okay, so it also, the con, it is the most tax burden because you have now to file taxes in your own country and in the US. You better have a big team to take care of those taxes. In the next whiteboard, I'm gonna show you an example of selling a property with each one of these three ways of holding the property. Okay, so now let's do an example to understand these three types of holding structures. So we are going to sell a property, a warehouse property. The acquisition price was 1.5 million and we are going to sell it for 2 million. So we are having $500,000 profit. The annual rent for that property, that will be around 140K thousand US dollars. Okay, so the first form of ownership is the direct ownership. So let's do the same example as in the introduction. We are receiving this property from an inheritance, and then we are selling the property to try to pay the state tax. Okay, so the state tax will be, first, this property, we assume it's free and clear, because otherwise we will be in big problems because we have to pay the bank and then we don't have any money. For this example, let's assume this is a free and clear property, purchase this property cash, and then we are selling. So The state tax will be $800,000. The FIRTA withholding tax will be $300,000, which will be 15% of the gross income, which is $2 million, and the state tax is 40% of the value of the property, which is $2 million again. The rent withhold with this structure, if we don't elect an effectively connected income with the IRS, our property manager would be withholding around $42,000 a year. Okay, so the money in from the sale, okay, how much we have on the sale? We have now $900,000 US. This is before income tax. We have again, we have to calculate our income tax, and then we have to pay more taxes. You understand now why this is a tax trap? Okay, so the second option is holding the property through a US Corp. In that case, the estate tax will be still $800,000 because we hold the corporation. We now don't hold the estate, the property, but now we have the stocks of the corporation. Okay, so we have to pay $800,000. Okay, the FIRTA will be zero because now the corporation holds the real estate, so they don't have to withhold because it's a US corporation. Rent withhold again will be zero because it's a US corporation, so rent withhold it's only for foreigners. Okay, so how much money will be getting before income taxes will be 1.2 million. So again, we end up with less than our parents or family invested in the property, which was 1.5 million. Okay, so the last structure, it's the two-tier. Now we have ownership on a corporation in a foreign country, which would be maybe our country or another offshore jurisdiction, and that corporation holds now a US corporation, and that US corporation holds the real estate. So in this case, the state tax will be zero, okay, because now the US corporation it's held by another corporation. It's not an individual, so state tax doesn't apply in this way. FIRTA withholding, now we have the corporation again, the US corporation holding the real estate, so FIRTA don't apply in this case. Rent withholding again don't apply because the real estate is into a US corporation. Okay, and the money in will be 2 million. Okay, we sold and we have back those 2 million. Okay, now again, this is before income tax. We have to calculate the income tax based on the profit. Okay, on the profit and all the costs and all the expenses. Okay, but basically we got again the money or hardworking parents inherit us and some profit from their investments. Okay, so in this video I teach you how to avoid the tax trap Uncle Sam has for you when you invest as a foreigner in US real estate. So which one of those three forms of holding the real estate do you like most? Write on the comments. So if you like this video, give me a thumbs up. Really, it helps me a lot. And also, if you want to keep watching videos like this, hit the subscribe button, and that way you will get notified every time I upload a new video. If you want to start investing in commercial real estate in the United States, but maybe you don't have the time or maybe the money to start in, you can join my exclusive investor club. My investors start investing from $20,000 US, and the best of it, it's totally stress-free. I manage everything. You can join by clicking on the link below on the description, and that way you get notified every time I find a new investment opportunity for you. Thank you for reaching this point and watching the full video. I see you on the next one. But first, I will leave you with 2 more videos here.